Welcome back to the Deep Dive. It is Friday, February 6th, 2026. And I have to say, looking at the research stack you sent over last night, I had a bit of a moment.
Oh,
Yeah. We usually talk about tech companies that live entirely in the cloud. Software, AI, all this intangible stuff. But today, we are talking about concrete. We are talking
okay.
about steel. We are literally talking about the skyline outside the window right now.
It's interesting you frame it that way because the company we are looking at today is really trying to blur that line. They're trying to turn that very real concrete into code.
Right. But before we get to the specific company, I want to challenge you a bit on the opening stat in the research.
Sure.
You led with this just massive number.
Yeah.
The global real estate market is an asset class worth over 300 trillion US dollars. That's trillion with a T.
It is. I mean, it's the largest asset class in human history. It's
Right.
bigger than all the world's stock markets combined, bigger than the global bond market. It is, quite literally, where the world stores its wealth.
Okay, but here's my problem with that number. It feels like a vanity metric,
Hmm.
you know? So what if the market is $300 trillion? If I'm a small cap tech company in, say, Mumbai, that number is almost meaningless to me. It's just too big to be actionable. Why should I, or why should you, the listener, actually care about that macro number?
You should care because of the inefficiency. That is the entire key. Look, if you have a $300 trillion market that is running perfectly with perfect information and zero friction, well, there's no money to be made. Efficiency squeezes out profit.
Okay.
But real estate, it's a dinosaur. The research indicates that something like 98% of that market is what they call open.
Define open for me, because in the software world, open is usually a good thing. Open source, open standards.
Right. It's the opposite here. In this context, open means analog. It means unorganized. It means that 98% of that massive world-altering value is managed via, paper trails, handshake deals, gut feelings, and phone calls that don't get recorded anywhere.
A digital desert.
It's a complete digital desert. The served market, the part that actually uses modern technology to transact or manage assets, is less than 2%. It's a rounding error.
So the core thesis here isn't just real estate is big. It's real estate is big, dumb, and incredibly slow.
Precisely. And that friction, that slowness, is expensive. It costs real money to wait 6 months to sell a house. It costs real money to not know if your tenant is going to pay rent on time. That friction, that inefficiency, that is the opportunity. We aren't looking for a company that buys buildings. We are looking for a company that wants to tax the movement of that $300 trillion.
Which brings us to today's subject, Aurum Proptech Limited. Now, I've been following the Indian markets for a while, and this name pops up occasionally, but depending on who you talk to, the description changes completely. Some people say it's a holding company. Others say it's a tech conglomerate. You use a very specific phrase in the notes that I want to interrogate. You called it an operating system for the Indian real estate sector.
I stand by that. I think it's the most accurate description.
It sounds a little like marketing fluff, though. Does a broker in Pune or a developer in Noida actually care if there's an operating system? Or do they just want to sell units faster?
That's the thing. They don't know they want an operating system. That's the trick. But think about how you use your phone. You don't think about iOS or Android. You just expect your photos to seamlessly sync with your messages, which sync with your calendar, which sync with your maps.
It all just works.
It just works. In Indian real estate right now, nothing syncs. The developer doesn't talk to the broker effectively. The broker doesn't have the data the buyer needs. The rental manager is using a different spreadsheet than the property owner. It's chaos. Aurum is trying to build that invisible back-end layer that connects all those fragmented pieces.
And the reason we are doing this deep dive today, specifically, is because of what just happened in their financials. We are looking at their Q3 FY26 results for the quarter that ended December 31st, 2025.
This is the quarter where the rubber finally met the road, the moment the story turned into numbers.
It really looks like an inflection point.
Mm-hmm.
I mean, for years, this company has been acquiring startups, burning cash, and promising that one day it would all come together and work.
Yeah.
And looking at these numbers, they just posted a profit after tax paying for the very first time.
And not just by a little. Revenue is up 77% year over year.
Which is a huge number.
And that 77% isn't just a small base effect. This is real scale starting to show up. But, more importantly, they flipped from a massive loss to a profit. That changes the entire conversation. It goes from, is this a risky venture capital experiment to, is this a sustainable, scalable business?
But we are definitely going to tear that P&L apart later because I have some, let's say, skepticism. about how they reach that profit. I'm seeing some other income lines in the report that look a little convenient.
That's fair. And we need to be forensic about it, no question.
But first, let's widen the aperture. Let's talk about the landscape.
Yeah.
We've established the market is big and inefficient. But why is this happening now? Real estate has been inefficient for hundreds of years. Why is 2026 the year this all changes?
Well, it comes down to a concept in economics called elasticity. Real estate demand is traditionally inelastic.
Right, meaning people always need a roof over their heads. It's a basic need.
Exactly. If prices go up, you still need to rent. If prices crash, you still need to buy. The demand persists through cycles. But the efficiency of the market, that is highly elastic. For decades, the industry just accepted that transactions were slow and painful because there was no viable alternative. The cost to digitize was just too high.
You needed mainframes, custom servers, entire IT departments.
You needed a fortune. But now, cloud adoption is over 60% and climbing. AI models are practically a commodity you can rent. The cost to fix the inefficiency has completely collapsed.
So the technology finally caught up to the complexity of the problem.
It's finally cheap enough and powerful enough to tackle a problem this big. And on top of that, you have these huge structural drivers that are unique to right now. Urbanization is the obvious one.
More people moving to cities.
More people, more density, more complexity. You simply cannot manage a 50-story residential tower with a paper notebook. It's physically impossible. You need software for complexity management.
And specifically in India, there's a massive regulatory push, isn't there? I'm thinking of things like RDRA. The government is tired of the black money and the general opacity of the sector.
It's a huge push. RDRA, the Real Estate Regulatory Authority, completely changed the game a few years ago. It forced developers to be transparent about timelines, about funding, about everything. And you can't be transparent if your records are buried in a file cabinet. You have to digitize just to comply with the law.
So the government is essentially holding a gun to the industry's head and saying, get modern or else.
In a way, yes. They've created a mandatory catalyst for adoption, which, for a Proptech company, is the perfect tailwind.
I want to highlight a nuance here about the Indian market versus, say, the U.S. or U.K. markets. In the U.S., you have Zillow, you have Redfin, you have the MLS. It's fairly consolidated. If I want to know what my house is worth, I can get a pretty good estimate in about 10 seconds.
Right. There are established data sources, even if they're not perfect.
But in India, that public data infrastructure just doesn't exist in the same way. It is incredibly fragmented. You have thousands of developers, tens of thousands of individual brokers, millions of landlords. There is no central, trusted database.
Which, counterintuitively, actually helps a company like Aurum, doesn't it?
How so?
Well, it's the classic aggregator argument. If a market is perfectly efficient and transparent, you don't really need a middleman. But if a market is chaotic and opaque, the person who organizes the chaos becomes the kingmaker. Aurum isn't trying to compete with a Zillow. They are trying to build the underlying infrastructure that would even allow a Zillow-like experience to exist in such a fragmented market.
So they're building the plumbing for the entire industry.
That's the goal. They want to be the pipes that everything flows through.
Okay, so let's get into the how. Let's talk about what Aurum actually does. Because when I first looked at their corporate structure, it just looked like a laundry list of random companies they'd buy. It felt a bit like they just went on a shopping spree with no coherent strategy.
It can definitely look like that from the outside. It's not a clean story. But if you map it out, they are very deliberately trying to build what they call the Proptech value chain. They've organized it into 3 main buckets.
All right, let's break it down. Bucket number 1, SaaS, software as a service.
This is the B2B engine, the real core of their tech play. The flagship products here are Sell.Do and Kailas. These are basically CRM's customer relationship management tools.
Okay, I know we have a smart audience, but let's be very specific. Why does a real estate developer need a specific CRM? Why can't they just use something off the shelf like Salesforce or HubSpot?
That is the perfect question. It's the vertical SaaS versus horizontal SaaS debate. Salesforce is horizontal. It's designed to be a one-size-fits-all solution for everyone, from a local bakery to a global bank.
It's a blank canvas.
Exactly. But real estate has very, very weird and specific workflows. A lead comes in, but maybe they don't actually buy for 3 years. Or maybe they buy, but then they need a home loan and you need to track that process. Or maybe they're an investor who wants to buy 10 units at once. Sell.Do is pre-configured for that entire journey. It tracks inventory, which specific apartment unit is available, which floor it's on, which direction it's facing. Salesforce doesn't do that out of the box.
So it's incredibly sticky. Once a developer uploads their entire inventory of 1,000 apartments into Sell Do It
Yeah.
and trains their entire sales staff on it, they're not going to switch to a generic tool.
Correct. The migration cost would be an absolute nightmare. It creates a walled garden for their data and their processes. Then, in that same bucket, you have the house monk.
It's the same concept, but for the other side of the coin.
Precisamente. It's for property management. Managing rentals, service requests from tenants, gate security, maintenance schedules. It's the operating system for a finished building, not one under construction. And finally, you have Aurum Analytica, which is the data layer that sits on top of all of this.
The intelligence layer, we'll come back to that. So that's the B2B software side. Then you have bucket number 2, REAS Real Estate as a Service. This sounds more consumer-facing.
This is where they actually touch the physical asset. The big names here are Nestaway and Hello World. These are essentially co-living and managed rental platforms.
Now, Nestaway has a bit of a history, doesn't it?
Right.
It was a darling of the Indian startup world for a while, raised a ton of venture capital, and then kind of crashed and burned.
It did. It hit a wall. Aurum bought it for a fraction of its peak valuation. It was a classic distressed asset purchase. But the logic was, Nestaway, for all its faults, controlled the supply. They managed thousands of homes across the country. And if you control the homes, you control the data on rental yields, on tenant behavior, on vacancy rates.
So they bought the data as much as the business.
I would argue they bought it primarily for the data and the physical footprint. And then there's Aurum Infinity in this bucket. This one confused me a bit at first. They call it fractional ownership.
Explain that. It sounds complicated.
Think of it as democratizing real estate investment. Usually, if you want to buy a piece of a high-end commercial office building, you need millions of dollars. You have to be an institution. Aurum Infinity takes that office building, breaks it up into thousands of tiny digital shares, like a stock, and lets retail investors like you or me buy in with much smaller amounts of money.
So I could own 0.001% of an office tower in Bangalore.
That's the idea. It opens up a whole new asset class to the masses.
Okay. And finally, the third bucket, and this really seems to be the big story of Q3, distribution.
This is the engine room. This is Proptech.
They completed the full acquisition of Proptech in July 2025. This is a massive, established real estate marketplace. But here's my question. Brokerage is a famously low-margin, high-headache business. It involves dealing with angry buyers, flaky sellers, endless paperwork. Why would a high-margin, scalable tech company want to get its hands dirty with a low-margin brokerage?
Because without distribution, technology is useless. It's the empty bar problem. You can build the most beautiful, sophisticated bar in the world, but if nobody comes in to buy a drink, you have no business. You have no data, no revenue, nothing. Proptech brought the customers. It brought volume. It brought liquidity from day one.
And the numbers back that up. You said in Q3 alone, the distribution revenue doubled to nearly 60 crores.
Doubled in a single quarter. That is the immediate impact of the acquisition fully consolidating into their financials. But more importantly, it turned that segment profitable. That segment made over 11 crores in profit. It went from being just a concept to being a cash-generating machine overnight.
So they didn't build an audience. They bought one.
They bought the flow, the river of transactions. And now that they own the river, they can start to cross-sell all their other high-margin services to the people floating by.
That brings us to what you call the customer web. You described a scenario in the notes where a single person could conceivably touch 4 or 5 different Aurum products over a decade without even realizing they're all connected. Walk me through that.
Okay, let's create a hypothetical person. Let's call her Priya. Priya is a 22-year-old student who moves to Bangalore for her first job. She needs a place to live, so she rents a room in a co-living space managed by Hello World. It's easy, it's safe. Aurum gets a management fee.
Okay, touch point 1, check.
5 years later, Priya's gotten a promotion, she's saved up some money, and she wants to buy her first home. She goes online to Proptech to search for listings. She finds a few she likes and submits an inquiry. Aurum now has her as a high-intent buyer lead.
Touch point 2.
Now, that lead is sold to a real estate developer. That developer uses Do as their CRM to manage all their customer interactions. So Priya's entire journey, every phone call, every site visit, is now tracked inside Aurum software. Aurum gets a SaaS fee from the developer.
Okay, that's 3 touch points. This is getting interesting.
It gets better. The developer's sales team uses Aurum Analytica to score Priya as a lead. The system might say, based on her search history, she's 85% likely to close in the next 30 days. Prioritize her. And maybe, just maybe, 10 years down the line, Priya is a successful professional. She has some spare cash to invest. She gets an email about a new fractional commercial property opportunity via Aurum Infinity.
It's a cradle-to-grave ecosystem for property.
In theory, yes. They want to capture the value at every single stage of a person's real estate life cycle. And because they own the data at every stage, they can start to predict when you are ready to move from one stage to the next. They'll know you're ready to buy before you do.
That's the super app dream. But we've seen so many super apps fail. We've seen companies try to do too much and end up doing everything mediocrely. What makes this different? Why won't this just become a bloated, inefficient conglomerate?
That is the single biggest risk. It's the execution risk. But they have, I think, very consciously tried to build what I call moats around their business to protect themselves from that fate.
All right, let's audit these moats. Moat number one, the distribution advantage. We've talked about the impact of PropTiger.
Let's really double-click on that. Think about the cost to replicate what PropTiger has. If you or I wanted to build a competitor tomorrow, we would need to spend hundreds of millions of dollars on Google ads, on TV commercials, just to get people to know our website exists. Then we'd need to hire thousands of feet on the street brokers to actually service the leads.
It would take years and a mountain of cash.
Exactly. Aurum completely bypassed that decade-long cash-burning process by acquiring an established leader. It gives them an immediate, almost insurmountable advantage over any pure-play software startup that's trying to enter the market.
Okay, that's a strong moat. What's moat number two?
Moat 2 is the tech stack. We talked about sell, do being sticky, but let's talk specifically about the data as a moat. In Q3, you mentioned they sold 117,000 leads via Aurum Analytica.
117,000, that's a huge number.
It's a massive data set, and every single one of those leads tells them something about the market. It tells them the demand for two-bedroom apartments in Whitefield, Bangalore is seeing a 10% price drop, or that buyers are shifting their first contact from email inquiries to WhatsApp messages. This is real-time market intelligence.
And a competitor who doesn't have that transaction flow simply doesn't have that data feed.
They're flying blind. Data is a moat that widens over time. The more transactions they process, the smarter their algorithms get, which in turn helps their clients close more transactions, which generates more data. It's a flywheel.
And that leads into moat number three, the integrated ecosystem. You mentioned something in the notes that I found fascinating about AI analyzing call transcripts.
This is where the tech gets really cool and, frankly, a little scary. So when a sales agent at a developer talks to a potential buyer through the cell, do CRM, the system can record and transcribe that call.
Okay, that's standard practice.
But then Aurum's AI analyzes that conversation in real time. It's doing sentiment analysis.
So it can figure out if the customer is happy or angry?
It goes deeper. It can figure out, oh, the customer hesitated for 1.2 seconds when you mentioned the final price, or their tone became more positive when you talked about the swimming pool. It then feeds that insight back to the developer's dashboard to help them tweak their sales pitch or even their project pricing. That is a feedback loop that a standalone broker or a standalone CRM simply cannot close.
It's turning sales from an art into a science.
That's the pitch.
It sounds incredibly impressive. But I'm the skeptic here today. It sounds like a great PowerPoint deck. Let's look at the bank account. Because for a very long time, Aurum was bleeding money. Q3 FY26 is what we're calling the financial pivot.
It is. It really is. Let's look at the headline numbers first, and then we'll dig into the weeds. Revenue from operations. 114.82 crores. That's up 39% from just the previous quarter.
And the big one, the profit.
Profit after tax, a positive 2.71 crores.
Okay, 2.7 crores, let's be real. For a company of this size, that is razor thin. It's barely black ink. A rounding error could have kept them in the red.
It is thin, absolutely, but context is everything here. Go back 1 year. In Q3 of FY25, they lost 35.43 crores. So this isn't a small step. That is a positive swing of almost 40 crores to the bottom line in just 12 months. That is massive.
How did they do it? Was it just cost cutting? Did they fire everyone? Did they cut marketing to zero? Because that's the usual playbook for a quick profitability fix.
No, and that's the crucial part. They actually grew the top line dramatically while holding the line on costs. This is where we have to talk about the beautiful concept of operating leverage.
Okay, explain operating leverage to me like I'm an investor, not an accountant reading a textbook. Where specifically in their profit and loss statement do we see it happening?
Okay, look at their expense side. You have two main buckets that are huge and relatively fixed. First is depreciation and amortization. For Aurum, That was almost 28 crores in the quarter.
Right. That's the non-cash cost of all the software they've built and all the companies they have acquired over the years being written off over time.
Exactly. That is a fixed cost. It doesn't change whether they sell one software subscription or a million. It's already sunk. Now look at the second bucket. Employee benefit expenses. It was 27.59 crores. It stayed relatively flat compared to the explosive revenue growth.
So you're telling me they grew revenue by 77% year over year, but they didn't have to grow their headcount by 77%.
Bingo. That is the holy grail of a software-driven business. Once your revenue grows enough to cover your fixed costs, your servers, your core team of developers, your depreciation, every additional rupee of revenue flows almost straight to the bottom line. They crossed that critical threshold this quarter.
And we see that in the margins. The EBITDA margin jumped to 6.5%.
An 885 basis point improvement year on year. That is the leverage kicking in real time.
However, I have to point out the elephant in the room, or maybe it's the mouse in the room, given the size, other income. They booked 9.73 crores of other income.
I was waiting for you to bring that up. It's the big asterisk on the quarter.
It has to be. If their final profit was 2.7 crores and they made 9.7 crores from other income, which is usually just interest on cash they have in the bank, or maybe some one-time asset sales, doesn't that mean their actual operations are still losing money?
Technically, at the final net profit level, yes. If you strip out that other income, their core business is still slightly in the red.
So is the turnaround story fake? Is it an accounting trick?
I wouldn't call it fake, but it is aided. Look higher up the P&L at the EBITDA line earnings, before interest, tax, depreciation, and amortization. That is positive. That means the core business operations before all the non-cash and financing costs are now generating cash. But the heavy fixed burden of depreciation and interest is still weighing down that final net profit number. The other income was the cushion that helped them absorb that blow and report a positive number.
So they aren't out of the woods yet.
No, not at all. I'd say they have just stepped out of the dark forest and into the clearing. They can see the sun. But they need to sustain this revenue growth for another 2 or 3 quarters to be truly undeniably profitable on a core operating basis without any help from other income.
Management is talking a big game, though. The investor presentation is targeting an annualized revenue run rate of 500 crores immediately, and then 1,000 crores within 3 years.
And that 1,000 crore number is the magic number. If they can hit 1,000 crores in revenue with this current cost structure, the profits will be substantial. The operating leverage that's just starting to kick in now will turn into an absolute profit machine at that scale.
But where does that growth, that doubling of revenue to 1,000 crores, come from? You can't just wish it into existence. Let's look at the future. Let's talk about the growth vectors for the next decade, from 2026 to 2036.
I see 4 main engines for that growth. Vector number 1 is the most straightforward. Deeper penetration, just getting better and more efficient at what they already do.
Squeezing more juice out of the orange.
Exactly. In the rental business, Nestaway added 2,200 new tenants in Q3. They're getting better at filling vacancies and collecting rent on time. But the real story is in distribution. Their new software sales for developers and brokers grew 67%. That is pure organic growth, just selling more of what they already have to a market that's still massively underpenetrated.
Okay, that's Vector 1. What's Vector 2?
Vector 2 is ecosystem expansion, and this involves a very important new partner, the REA Group.
Right, this got a little buried in the headlines about the Proptech acquisition.
It did, but it's a huge deal. When Aurum bought PropTiger, the REA Group, which is a global digital real estate giant based in Australia, they own realestate.com.au, became a major shareholder in Aurum.
So they have a global big brother now with deep pockets and a lot of experience.
Yes. And REA Group knows how to scale these platforms. They've done it successfully in Australia, in Southeast Asia, in the US. Having them on the cap table and on the board brings a level of global expertise and strategic guidance that Aurum never had before.
And under this expansion vector, there is this buzzword I keep seeing, SM REIT, Small and Medium Real Estate Investment Trust.
This is probably the most exciting and simultaneously the most dangerous part of their future plan.
Explain it. What is it, and why is it dangerous?
Okay, so traditionally, if you want to launch a REIT in India, you need a massive portfolio of assets. Think giant shopping malls, huge office parks. We're talking billions of dollars worth of real estate. The government is creating a new, more accessible framework for small and medium REITs. This would allow smaller, high-quality portfolios, say a collection of 10 luxury villas or a single grade A commercial tower, to be packaged, listed on the stock exchange, and traded.
And Aurum wants to be the platform that enables that.
Aurum Infinity wants to be the engine room for SM REITs.
Right.
They have the data to help value the assets. They have the distribution through Proptech to find the investors. If SM REITs take off, Aurum moves from just collecting brokerage and software fees to earning asset management fees. That is a massive high-margin revenue jump. It's a whole different ballgame.
But, and this is the dangerous part, it relies entirely on the government actually approving this new framework and making it work smoothly.
Which is never, ever a guarantee in India. Bureaucracy can kill the best ideas.
Okay, that's a big one to watch. Vector 3, the AI and digital shift. We touched on this with the call analysis, but is there actual revenue here today, or is it just a cool feature to put in a presentation?
No, it's real. Aurum Analytica is already doing 13 crores in revenue. That's real money from selling data and insights. And as the market shifts, brokerage itself is changing. It used to be about who you know. Now it's becoming about what you know. Sales intelligence. If Aurum can go to a developer and say, with data to back it up, hey, stop building 3-bedroom units in this neighborhood. Our data shows the real demand is for 1-bedroom studios with a home office. That advice is worth millions of dollars.
They're selling certainty in an uncertain market.
That's a great way to put it. And finally, Vector 4. Geography. They're not just staying in India. They're going international.
Dubai. Why Dubai? It feels like a potential distraction. The Indian market is enormous. Why not just focus on winning India first? Why go to the UAE?
Because the Indian buyer is in Dubai. A huge chunk of Dubai real estate is bought by Indian nationals, either as investments or second homes. It's a natural cross-border corridor for their existing customer base. Plus, the transaction values in Dubai are much higher. A 2% commission on a Dubai penthouse is worth 10 times a commission on a Mumbai apartment. And the regulatory environment there is very pro-tech. It's an easier, more lucrative sandbox to play in and test their international model.
Okay, so the growth story is there. You can see a path to 1,000 crores through deeper penetration, ecosystem expansion, AI, and geography. But we don't do puff pieces here. I want to look at the dark side. Let's really dig in. What kills this company? Section 6, the risks.
The biggest risk, without a shadow of a doubt, is the regulatory minefield.
And you're thinking specifically about the rental business and GST.
Yes. Look at GST, the goods and services tax. The rules on applying GST to renting residential property in India have been a mess. They've been flip-flopping. Is it taxed? Is it exempt? If the government wakes up one morning and decides to slap an 18% GST on all co-living rents retroactively, the nest-away business model breaks overnight.
The margins are already razor thin. You can't absorb an 18% tax hit.
You can't. It would be devastating. And we've seen the Indian government make retroactive tax demands before. The online gaming industry got absolutely hammered by that recently. One stroke of a pen in New Delhi could wipe out their profitability for years. And it's the same with the SM REITs we just talked about. If those approvals get stuck in bureaucratic limbo for 3 or 4 years, that entire growth vector just hits a brick wall.
Okay, that's a big external risk. What about internal risks? Risk number 2 in your notes, integration risk. And this brings up the key person, Onkar Shetty.
Onkar Shetty is the executive director. If you read the analyst call transcripts, if you watch the interviews, he is the guy. He is the one on the ground, articulating the strategy, explaining how all these pieces fit together. He seems to be the one driving the critical integration of Proptech into the wider Aurum ecosystem.
And integrating a company like Proptech, which has a very different sales-first culture than a tech startup, is incredibly hard.
It's a culture clash waiting to happen. It's cultural warfare. Proptech is high-energy, boiler room, sales-driven, close the deal. Aurum is, at its heart, a more methodical, tech-driven, engineer-led company. Merging those two cultures is notoriously difficult. If Onkar leaves or if the middle management teams start fighting over resources and priorities, the ecosystem breaks down. You just end up with 2 separate companies that hate each other, sharing an office but not a vision.
Okay, risk number 3, competitive intensity. They are not the only ones who see this massive opportunity.
Not by a long shot. You have Housing.com, you have the giant magic bricks, and you have the really aggressive one, No Broker.
And No Broker is a fascinating competitor because their whole model is kill the broker. Aurum's model with Beyond Walls and Proptech is empower the broker with technology. That is a fundamental philosophical clash.
It is. And in a price-sensitive market like India, the pitch of free or no brokerage is extremely powerful. If no broker decides to slash its fees to 0 or heavily subsidize rents just to gain market share and bleed out the competition, Aurum has to respond.
Which could lead to a race to the bottom.
A brutal price war that destroys margins for everyone involved. The rental business is particularly vulnerable here. The moat is just not as deep as it is in the B2B SaaS business.
So the moat isn't invulnerable.
No moat ever is. It just has to be strong enough to withstand the attacks.
Let's pivot to the people at the top, Section 7. Management and governance. Because ultimately, when you invest, you are betting on the jockey, not just the horse. Who is running this thing?
The founder and CEO is Ashish Diora.
What do we know about him? Because looking at his background, I found a lot of generic praise. He's a visionary, a serial entrepreneur, but not a lot of hard, specific operational history.
That is a very fair critique. He is clearly a visionary. He saw this Proptech wave coming before almost anyone else in India. He was the one who started acquiring these companies early on. But compared to some other public market CEOs who have a clear 20-year track record of scaling businesses from X to Y, his public profile is a bit lighter on the nitty-gritty operational details.
He's a deal maker.
An architect.
He is a deal maker. The big question for investors is, can he also be the operator? Can he manage the day-to-day execution of a complex 1,000 crore company? The jury is still out on that. Ankar Shetye seems to be the operational guy, but the buck stops with the CEO.
And what about skin in the game? This, for me, is my biggest red flag. I look through the latest shareholding pattern. I don't see the C-suite, the CEO, the executive director, holding massive personal blocks of stock. It is very thin. You see a non-executive director, Ramashri Yadav, owning a tiny sliver, 0.02%, but you generally want to see the CEO and the top team personally owning 5%, 10% of the company. You want them to feel the pain when the stock goes down and the joy when it goes up.
Right now, their primary incentive is their salary and maybe some options. They're effectively salaried employees.
Mostly, yes. Now, to be fair, the parent promoter group, Aurum Real Estate Developers, owns a huge chunk of the company, so the group is heavily invested. But the individuals running the day-to-day public company, it would be much better to see more direct personal financial alignment with minority shareholders.
On the flip side, the board governance structure looks okay on paper.
It's solid. 3 independent directors, which is good practice. They are very transparent with their disclosures. They publish detailed quarterly presentations, which is where we got a lot of this data. It's not a black box by any means, but the personal incentives for the top brass could definitely be sharper.
So, to summarize, we have a company that is trying to digitize the most analog, inefficient industry in the world's fastest-growing major economy.
Yeah.
They have finally just barely turned profitable. They have a massive distribution engine thanks to a game-changing acquisition. But they face existential regulatory threats and fierce, well-funded competition.
That is the whole story in a nutshell. It's a high-risk, high-reward bet on execution.
Before we wrap up, I want to leave our listeners with a final provocative thought. And this goes back to your point about the customer web and the data they're collecting.
Go on.
We've been analyzing Aurum as a real estate company. But think about the data they have. They know who is renting. They know how much they pay. They know where they work. They know when they get married and start searching for a bigger house. They know what developers are planning to build 6 months before it ever hits the market.
They have the real-time pulse of the entire market.
So here's the question. In a world where data is the new oil, is Aurum actually a real estate company? Or are they, in the long run, becoming a data monopoly that just happens to use real estate as its collection mechanism? Because if they succeed, they won't just facilitate the market. They might be the only entity in India that can accurately predict it.
That is the ultimate bull case. That's the 10-year vision. If you can predict real estate prices in a market as opaque and volatile as India, you can do so much more than sell houses. You can price risk better than any bank. You can underwrite home loans better than any lender. You can make direct investment better than any private equity fund.
They become the Bloomberg terminal for Indian real estate.
Exactly. And the terminal is always more valuable than the individual trades running through it.
So next time you walk into your apartment building and you see a security guard with a paper register, or you talk to a broker who pulls out a crumpled piece of paper with listings, realize that that is the competition. That is the 98%. And realize that there is a layer of invisible software that is trying to eat that paper.
And judging by their Q3 results, it's starting to take some very big bites.
That's it for this week's Deep Dive. We will be watching those other income lines and their cash flow statements very, very closely next quarter. Thanks for listening.